need a pen. Hand me that one.
Go.
Yeah. Welcome to the Infinite Wealth, not podcast, but our monthly live Q&A. So appreciate you guys joining us. Today, what we're going to be talking about is answering all your guys' questions, infinite banking related. And then today, what we're going to be talking about is how rising interest rates may or may not have affected policy loans. Yeah.
Sounds good.
Absolutely. Anthony, give some of these guys an introduction. What's the purpose of our live stream? Why did we start doing this?
Before we do this, there was one thing I was...
Wow.
Okay. All right. Now we can go into our introduction. Well, we wanted to do this live stream for a few reasons. For one, we wanted to be able to share ideas with and answer questions of what's going on with infinite banking, but also it's a way for us to connect with our clients where they can ask questions or non-clients can ask questions and we can be able to collaborate and share some ideas. If you're new to us, our firm is Infinite Wealth Consultants. And what we do is we combine the teachings of Robert Kiyosaki and Nelson Nash. All we do is infinite banking. We don't do IRAs, 401ks, or stocks. It's just really how can we use infinite banking specifically for investors? And our goal is let's create passive income more than our monthly expenses. Okay. And I'm Anthony Faso. I'm a recovering CPA. This is my business partner, Cameron Christensen.
And I'm not a recovering CPA.
No, but you wish you were.
Thankfully. Yeah. Anthony, so today what we're going to be talking about, kind of our topic that we actually got a few things on our agenda for today, but the big one that we want to address is a question that we've got quite often over the last couple of months, but have rising interest rates affected policy loans? And there's a couple things that we need to address when discussing this question. So Anthony, I'm going to throw it to you first. If you want to start on maybe one or two of them, and then I'll add some or however you want to add to it. But yeah, let's address it. How's rising interest rates affected policy loans?
Great question. So far, they haven't impacted the rates yet. And we were just on the call with one of the insurance companies we use, and let's just be a little clear. The interest rate is determined at the beginning of the year. So thus, there hasn't been a change yet, but I'm anticipating a potential change in January.
And well, I would say that we are seeing some changes across the industry, and so I would expect a change here shortly.
Yeah, and really the interest rate, as long as we've been doing this, and I know I've been doing it like 2 days longer than you have, the interest rates have not changed.
They haven't.
Right. And the interest rate, get a little technical, is typically going to be 1% higher than the guarantee rate. So if you had policies before 2022, that guarantee rate was 4. Thus, the interest rate, Cameron,
it's 5.
It's 5, right?
I got that.
Then
I'm not even a recovering CPA. I got that one.
Now in 2022, they allow the insurance companies to come up with their own guarantee. So some of those guarantees are lower, so the loan rate's lower. But what we've typically seen, most companies that we work with lower the guarantee to 3, and thus the loan rate is 4. Since we're talking about the guarantee rate, there's a lot of misconception on that. And what I do like to clarify is that's a gross rate.
Yeah.
So that is before cost of insurance and other expenses. So it's not going to be 3% plus dividends. What we found historically, to me, it's all about the bottom line. I don't care what the gross is or what. You got to take everything, take all the expenses out. What am I going to have at the end of the day? And that's typically going to be about 4. So with these loan rates, we're going to find out shortly here, typically in November, on when those rates are going to be. And so what the rate is, it's going to be the greater of 1% above the guarantee rate or one of the Moody bond indexes. And so that index is around 5.1 right now. So I can see some insurance companies will be raising their interest rates. But what I'm trying to tell people, for one, we don't have control about rates,
Mm-hmm.
right? But let's keep in mind that dividends follow interest rates. So as dividends are low, I'm sorry, as interest rates are low, dividends are going to be low. As interest rates rise, dividends will rise. So as we see these interest rates rising, we should be seeing dividends rise.
Mm-hmm.
And also, when we're using this policy for an investment purpose, say, for example, to buy real estate or you loan it to your business, that interest can be tax deductible. So then, in theory, if interest rates get much higher, we're going to be able to create some tax deductions.
Mm-hmm.
And the dividends will be higher as well. So we're going to be having more tax-free income and actually higher tax deductions. So for our investors, the higher interest rates are actually going to improve the results of your policy.
Anthony, as you'd mentioned something kind of while we were prepping for this, is you said, hey, I don't mind if my loan rate is 20%. Can you kind of repeat that or maybe touch on that here for a second? I think that's where you're going, but I'm just attaching some numbers to it for our listeners.
Yeah. If my loan rate is 20%, I'm going to be happy. And the reason being is that 20% is tax deductible. Let's just say we're in the 40% tax bracket, right? So I'm saving 8%, or let's say we have 100 grand. I'm saving 8 grand in taxes, right? But I should be with that higher rate should also account for a higher dividend rate, which means maybe I'm earning close to that 20% tax-free income. So my cash value is growing higher tax-free, and I'm actually able to create higher deductions.
Well said. Well said. So let's give them kind of a recap here, right?
Should we talk about the LELOC?
Well, yeah, absolutely. No, we're going to get there, but I was going to give kind of a summary, right? For those is that, hey, if we're looking right now, have rising interest rates affected policy loans? At this point, the answer would be no. They haven't, but I would anticipate these interest rates to be moving kind of towards the end of this year, early next year, right at January when they reset them or have the potential to reset them. So no, they haven't, but they could be. So we're kind of giving you guys a heads up. And then also number 2 is the LELOC, right? The LELOC is, if you've been listening to us for a while, it's the life equity line of credit. And this is when you're taking a policy, right? Your cash value and potentially a premium deposit fund account. And you're putting that up as collateral with a third party, a bank. And then that bank is extending you a line of credit between those two balances. And so we have seen some movement in those interest rates. Anthony, you mind touching on that?
Yeah. Going back a few months ago, we could get that loan rate as low as 3%, which was great. But that is, I mean, they're both a LELOC rate or policy loan rate. They're both variable. But as we said, the policy loan rate, it changes on the calendar year. LELOC rate it changes month to month, and as the Fed's raising the rate, that's raising the interest rates on the LELOC. So now the LELOC rates, those are tied to prime, and prime I think now is 6.25.
Yeah, it's right there, 6.5.
So typically the LELOCs are a point, sometimes a point and a half below prime. So right now, for some policies, and even on mine, my LELOC interest rate is higher than if I were to take a policy loan rate. And I tell you, and again, we are an open book, telling what and how we are utilizing and what we're doing with our policies. For right now, that spread to me is about, I think, 1/4 of a point and maybe even 1/2 a point. Right now, the benefits of having the LELOC outweigh that small increase. So I'm not making any changes, but it's possible the LELOC rates could go even higher. And if they are much higher, I tell you what, I'm going to wait to see what the insurance companies come out with in January. And if the LELOC rate gets too high, you know what? I can just unwind the deal. I can just close the LELOC and take a policy loan and pay it off. So, and there's no cost or fees to do that. So I have that ability to do that if and when that happens. But right now, I'm just kind of setting the course. And again, the ability to have checkbook access to my funds, particularly with what's going on now, I think that liquidity is going to be very helpful. So right now, I'm not making a move. But if you're getting a policy now, I'm typically telling my clients, let's just hold off on a LELOC. You have anything to add, Cam?
No, kind of. The idea that came to my mind was optionality, right? I've spoken about this before, is the idea of anti-fragile and having options available to you. And that's what we've got, right? Is we can always kind of fall back into the safety and security of the policy. If we've got better options available to us, yeah, we're absolutely going to go out there and utilize those. But man, if those start to go sideways or those interest rise, we can always just rely on the safety and security of the policy. So,
Cameron, is optionality a word?
It is.
It sounded good, but I wasn't sure if I've never heard it before.
It is. It's there's a whole chapter in Talib's book about it, and anti-fragile actually was not a word prior to him writing that book as well. So,
great book.
Exactly.
Great book.
Exactly. Yeah. Exactly. So, awesome. So we got a couple other things, right? Is if you guys have questions, right? There is a lot going on, right? Rising interest rates are affecting a lot of things. Inflation is affecting a lot of things. There's a lot of what I would call uneasiness or uncertainty out there right now. And if you guys have questions, man, feel free to give us a call, right? We've got a link to our calendars. If you guys have any questions, if you guys want to reach out and address any questions with us individually.
Yeah, and if you're watching this live, go ahead and you can put it in the comments or the chats. If you're watching this recording, what you can do is you can either email us and at info@infinitewealthcourse.com, or you can DM us on Instagram, Infinite Wealth Consultants, and we'll go ahead and put it on our next Q&A.
Yeah, you can tag Anthony on TikTok. I think he's the only one on TikTok that I know.
But I will say, if you're just kind of new to IBC, you're still doing your research, what we'd recommend is get on a call with us. No cost or obligation. Maybe we can answer some questions, point you in the right direction to get some more research, and really to kind of see if maybe IBC or Infinite Wealth is for you. And you can do that by scheduling a discovery call. And I'm going to go ahead and put that link in the comments here.
Nice. Well done. The other question that we had is with rising interest rates, does IBC still work? Why are you looking at me like that?
I thought you were going to answer it. But...
I thought you were looking at me like, hey, we just answered that. I'm like, no, we didn't. Right? Does IBC work? Yeah, absolutely. IBC still works, right? I don't know if I want to touch on this now or later, but I had a conversation with a client that essentially asked this earlier this week. And one of the things that I touched them about is that infinite banking is, if you put a plan in place based upon kind of interest rates, man, you are going to be blown with the wind left and right throughout the next 20, 30 years, right? Infinite banking absolutely works. The foundation of it is a non-correlated asset. It's the whole life policy, right? That's our safety. That's our security. When interest rates rise and fall, there's certain assets to be better invested in as opposed to others. And so if we're hanging out, we've got our cash inside of that policy, interest rates are going up, man, we're going to move it into certain asset classes. And so IBC absolutely still works. IBC gives you optionality, right? Moving forward in the market and those types of things. So yeah, IBC certainly still does work.
And really, honestly, I think people get and we do as well. We get too focused on the return to the policy. And again, we're focused on helping investors.
Yeah.
And we only want to keep the money inside the policy if we don't have an asset to use it for. So what we're really saying is, if you don't do IBC, where else are you going to store the money?
Hmm.
Probably it's going to be in a bank earning next to nothing.
Yeah.
Yeah, but here, by moving it into a policy, you're going to be earning much more, and it's asset protected. So we need a place to store the money, and I would love somebody to show me a better place to store that money than inside an IBC designed whole life policy.
Yeah. Anthony, here's another question we get a lot.
Yeah.
How many policies should I have?
As many as you need.
Great. How do you determine need for number of policies?
The way that I like to design them is, in essence, what we do is the client, you decide how much you want to put into the policy, right? And depending on those numbers, we may just put it on you, or maybe if the number's large enough, we might split it between your spouse and your children. I also, we don't spend enough time on death benefit.
I agree.
We're just focused on the cash value. With a lot of times, we would recommend somebody getting the convertible term. So that's another policy, but at least that protects the family. But we can also convert that to whole life when you're ready for cash flow wise. So to me, I don't think there's whether you have 10 policies for 10 grand each, or you have one policy for 100 grand. It doesn't matter.
Yeah.
Right. What the number needs to be is how fast you want to move. I mean, the reason why I have so many policies is, for one, I wanted to check this out. Right. You read the book and this all sounds great. Like, it almost sounds too good to be true. So I didn't trust it. I did my research, but still, I put my toe in the water and I got a small policy. And then as I felt more comfortable and saw that it worked, just like Nelson Nash did, I got another policy. Then I got a policy on my kids. And then as my income grew, I needed another place to store the money. So the number really is immaterial. And I think that comes from, because people just think, well, I can only have one life insurance policy. The limit is going to be not on the number of policies, but on the amount of death benefit you can have. Insurance company is only going to insure you for so much death benefit, whether that's one policy or 10. And it's great. It's a good problem to have if we're up to the max insured. That's when we start looking at others. I know we have policies on each other, policies on Becky, and we start looking at third parties.
I was going to share just an example. I was talking to a couple, actually, let's say Thursday, I don't know, Tuesday night or whatever it was, but they're back east. So we met after they put the kids down, and they want to start banking policies. And there's really two funding sources. One of it was going to be cash flow, is what they're able to contribute. So they come up with a good monthly number that was really easy for them to kind of contribute. And then they had a bunch of cash that was sitting over here. And so that cash, is kind of a funding source. And they've accumulated it kind of over time. And so what we did is I just took that, I put it into a one and done policy, and I designed that policy on the wife. And so that was hers. And then what I did is I put the kind of monthly contribution on the husband. And so, depending on what somebody's comfortable with is, hey, we got to look at cash flow, then we got to look at cash that's available, and then we'll design it around that. What else? What else we got, Anthony?
Well, you were going to share a little. No.
Yeah, absolutely. There's a couple of things, right?
Yeah.
As we're kind of preparing for this, this is a way for you guys to kind of reach out to us and ask us questions, and we're available, address anything IBC, passive income related. But it's also an opportunity for us to kind of maybe give you guys a little bit more insight. And so I looked over the course of my week, and there's really two things that kind of jumped out at me. And one of them was really a couple, and they were asking some of these same questions. I alluded to it earlier, but hey, with rising interest rates, with this idea of uncertainty that we're looking at in the economy, is doing this still a good idea? And I sat there. No, and right is I'm completely biased, right?
Yeah.
Everybody should know that. Yeah, this is, but I sat back and I tried to kind of think of some very good reasons. And man, the first thing that came to my mind was IBC. This is the time in which IBC really shines.
Mm.
Right? When things are going sideways, they're going left, they're going right, maybe they're going down, I don't know, right? But this is when IBC is really at its best, is an insurance policy that's designed for cash. It's a non-correlated asset. So what that means is that it's not tied to the stock market, it's not tied to the real estate market. So all it does is sit there and churn out returns. And when you've got the stock market that might be performing decently or the real estate market performing decently, sometimes people will be like, you know what? I don't have time for 4% returns every single year. And so when things go sideways, now they look at this and they're like, oh man, I would die to get all my cash and capital inside this thing, right? And so, man, infinite banking is designed, if you do it appropriately, man, it's going to shine in good times and in bad. And so right now, I think we're really going to see that. But more importantly, right, Anthony, is, man, I took them back to their goals. And I was like, what are we trying to get accomplished here? Well, they're trying to create a couple businesses and they're trying to create income. And so we started talking about that, right? Their scenario was the wife had just started a business 3 years ago. And so everyone knows what was going on the last couple of years. And so she's kind of been in a start-stop situation, but she just had the best quarter that she's had in 3 years. So she was excited about that. Yeah, it was awesome. And then the husband, right, he's got a full-time W-2 job, but he's looking at buying a laundromat, right, that he can start to build and start building that kind of business portfolio. And so if you look at that scenario, they were taking a large majority of their capital and they were looking at putting it into another investment that I would say is very illiquid. And again, right, so we visited this and we just kind of went through the whole situation. I took them back to the hierarchy. We go to tier number 1, right? Tier number 1's our foundation. We looked up at tier number 2. Tier number 2, the types of investments that we should be making is going to be business, real estate, and then ourselves. And then the investment that they were looking at making was all the way up in tier number 3. And so what I relayed to them, he's sharing it with, awesome.
Trying to. This mouse isn't working too good.
Well, if you share it, they're not going to read your handwriting either. So
I know. I was looking for one that we had with yours. I don't even know. Maybe we shouldn't share that.
Just share it. It's good. This is good.
Okay. All right. Go ahead and make fun.
Yeah. Guys, right? I don't know if you guys have had how many meetings somebody's had with us, but this right here for me, this is where we start our meetings. Is we kind of lay out our hierarchy of wealth, which is what I was just going through with you. I won't go through it again, but the foundation, right? That's where we're looking at cash and cash value. Number 2 for us is really where we start to kind of look at making investments in business, real estate, and then ourselves. And tier 3, right? That's where we're going to actually hand over some of our cash into somebody, whether it's a partnership or joint venture, something like that. But this couple was really trying to jump kind of from tier 1 all the way up to tier number 3. And so that's what we had discussed. We had a great conversation about just kind of focusing on our goals and saying, hey, listen, that investment that you're looking at making here in the short term, that is not going to get you guys to where you want to be, right? Is that a piece of it? Is that going to create some monthly income? Yeah, but great. But that's not going to get you to where you want to be. Really, it's going to be her business and it's going to be the business portfolio, right, that he's building and real estate portfolio that he's buying and building is going to get them to where they need to go. And so that was really the conversation that we had, is just try to refocus, get him back centered on this. And I don't know if you remember this article, right? It was written by Ben Stein. Mm-hmm. Ben Stein is probably one of the leading economists in the country, right? The guy that had that game show. But
Bueller.
Yeah. But he wrote an article, I think it was back in 2011 or 12. It was right after kind of the crash back then. But essentially the title was, "You'll sleep better having your money under your pillow than you would in the stock market," right? And that's kind of what I brought up to him was, hey, listen, if we've got cash and we've got cash on hand, you guys are going to sleep better over the next 12, 24 months, knowing you've got, 150, 200,000 of cash available, as opposed to having 75 or 100,000 of cash available to you. And so that was really what it came down to. And so just a real good conversation that I wanted to kind of share with you guys, because A lot of people are going through that, right? As much as we talk about passive income, sometimes making that leap up to tier number 3 really isn't in our best interest, right? It's really getting focused on kind of our business, our skill set, and then what we can create here in the short term. So
now, Cameron, you'd mentioned that in difficult times is when infinite banking or whole life kind of is what we're talking about in particular shines.
Yeah.
I think you're right.
God, we got that recorded.
You want to know what doesn't shine?
What?
During bad times?
What's that?
IULs.
You teeing it up for me?
Yeah.
That was the other point that I wanted to make was I don't know about you guys, right? If you look at IULs, right, and the reason I'm so fired up about this is because it came up in conversation earlier this week, is that, right, somebody's looking at doing infinite banking. They're approached by somebody else that's recommending that they do an IUL. Guys, you should not be using IULs for infinite banking. And right now, if you look at where the stock market is, right, that is an investment-based policy or product. I mean, it is down over 20% year to date. I don't know how somebody could sit across from someone today and say, hey, listen, this is exactly where you should be putting your money. I think it's absolutely crazy that somebody would be making that recommendation there today. And then number 2, guys, if somebody's presenting you with these options, right, if you're looking at investing or putting your money into an insurance policy or whatever it is, read the contract, right? That is the first question that I always have for somebody is, man, this stuff, there's a little bit of legal jargon in here, but you can get through it. You can understand it. And if you don't, man, call us. I'm happy to take the time and go through whether it's a whole life contract or an IUL contract with somebody just for the education piece. And if you don't trust us, man, go watch our videos, right? Anthony, we get this question so many times over the years that we've actually kind of put this out there available for anybody that wants to go check this out. It's on our website. It's right there at the very top. It says why we don't recommend IULs. Guys, in this little tab here, right in our course, when you get in there, we're going to look at IULs. We're going to go and we're going to look at the options that's available to somebody, and we're going to read the contract for you guys, right? And then we've got a whole bunch of supporting documents that talk about some of the pitfalls associated with that type of product. And not only the pitfalls associated with it, but a little bit about the history of it. And if you guys understand the history of it and the way that it was even created and designed, and then also some of the downsides, you guys are quickly going to see that is not a place that somebody should be storing long-term wealth. So that's my rant for today.
What I would say, you know who doesn't recommend IULs for IBC is Nelson Nash, the creator of Infinite Banking. I was trying to find the page, but he specifically says not to use IULs. Okay. And to me, the biggest misconception of IULs is that, well, if the market goes down, I'm not losing any money.
Yeah.
Right. Again, like Cameron said, you have to read the contract. The way IULs work is they're basically buying options for the next year. And if the market does well, they can trigger the option. And if it's not, they don't. Okay. But what that means is when the market goes down, you're credited 0. Okay. Which is true. But you're credited 0, but there's still expenses in there. And IULs can be very expensive. So if there's a period of the market where it is losing, kind of like where we're at now, you're going to be credited 0. But when you include those expenses, your cash value is going to go down. So any question about IULs, we did the math. You know what was very interesting? We even did a whole life and an IUL, and I think after 10 years, they were extremely close.
Yeah, right? Immaterial difference.
Yeah. So I tell you what, I'm looking forward to this recession for many reasons. For one, that's going to create some opportunities that I know being in having access to the policies and liquidity, we're going to be able to take advantage of those opportunities, but also maybe some of this sizzle of these IULs when people start seeing their statements and they're actually going down, not up. They'll create another opportunity.
Absolutely. The other point that I made, or that I'd like to make, is that I am not aware of a single reputable IBC advisor that uses IULs. That should say it all in itself right there.
Yeah.
So,
okay.
Outside of whatever anything Anthony has to add. Yeah. So, awesome. All right. So we covered a couple things, right? Interest rates, how it affect policies, kind of laying the foundation, give you guys a heads up of what may be to come. We also talked about some options and how the interest rates have affected locks, right? We do have some options there. If you guys have questions on either of those, feel free to reach out, give us a call. We're happy to help. If you guys have an IUL, I'm sorry, call us. We'll see what we can do, right? And then I think that was it, Anthony. Anything else that I missed there?
I'm sure you did, but I will address it later. I will put a link. I'll do it right now. I'll put a link into the IULs. We will be doing this every month, the third Thursday at 12 o'clock Pacific. So send us your questions. We are here to help educate about IBC and kind of share some updates. Go make it a fantastic day.
Take care.
Watch this.